Links to other systems. NSCC maintains a securities settlement account at DTC to allow settlement of net securities obligations. DTC also acts as settlement agent for NSCC to effect net fund settlement over NSS through a single NSS file. Each DTC and NSCC member designates a settling bank that participates in the DTC-NSCC-NSS arrangement. NSCC has entered into a multilateral netting contract and limited cross-guarantee agreement with DTC, the Fixed Income Clearing Corporation FICC, and the Options Clearing Corporation OCC, under which these clearing agencies have agreed to make payments to each other for any remaining unsatisfied obligations of a common defaulting participant to the extent that these clearing agencies have excess resources belonging to the defaulting participant. 4.3.2 Fixed Income Clearing Corporation, Government Securities Division FICC, GSD. 4.3.2.1 Institutional Framework. The Government Securities Division of the Fixed Income Clearing Corporation provides central counterparty clearing and settlement services for transactions in U.S. Treasury and agency securities. FICC is a wholly owned subsidiary of DTCC.25. FICC is registered as a clearing agency within is subject to regulation and supervision by the SEC. Also, FICC has been designated as systemically important by the FSOC, and under Title 8 of the DFA the SEC is its supervisory agency. 24 members may cap their exposure to future allocations by electing to withdraw from membership within certain timeframes. 25 FICC also operates its Mortgage-Backed Securities Division FICC MBSD, which is described in Section 4.3.3. 496 CPSS, Red Book 2012. United States. 4.3.2.2 Participation FICC GSD rules allow for the following types of netting members: banks, broker-dealers, futures commission merchants FCMs, interdealer brokers, government securities issuers, registered clearing agencies, insurance companies and registered investment companies. Foreign entities may become netting members if I, their home country regulator has entered into a memorandum of understanding with the SEC and e, they maintain a U.S. presence. Registered investment companies also may join as sponsored members. 4.3.2.3 Types of transactions. FICC GSD provides clearing and settlement services for U.S. government securities, including Treasury bills, bonds, notes, zero-coupon securities, government agency securities and inflation-indexed securities. FICC GSD accepts buy-sell transactions, repurchase and reverse repurchase agreement transactions, repos, and Treasury auction purchases in eligible securities. FICC GSD also provides General Collateral Finance Repo, GCF repo, services. The U.S. government securities market is predominantly an over-the-counter market. In 2010, FICC GSD processed around 34 million transactions with a total value of approximately $1.10 quadrillion. 4.3.2.4 Operation of the system. FICC GSD functions as a CCP for the U.S. government securities market and provides the real-time trade matching (RTTM) service to its participants. RTTM provides immediate confirmation for submitted trade executions that is legal and binding. FICC GSD members may submit their trades through interdealer brokers or directly to FICC GSD.26. Interdealer brokers are specialized securities companies that function as intermediaries to facilitate transactions between broker-dealers. Through multilateral netting, FICC GSD establishes a single net long buy or net short sell position for each member's daily trading activity in a given security. The member's net position is the difference between all purchases, long, and all sales, short, in a specific security. FICC GSD legally novates each net settlement position and members settle against FICC GSD as CCP. U.S. government securities market transactions are generally settled on a T+1 basis. FICC employs the services of two settlement banks, the Bank of New York Mellon BNYM, and J.P. Morgan Chase Bank JPMC, for the purposes of settling transactions. FICC GSD rules provide that FICC GSD shall notify each member which settlement banks FICC GSD will use to deliver eligible securities to members and to receive eligible securities from members, and, by product, the types of securities that each such clearing bank will deliver and receive. In turn, each member must notify FICC GSD of the banks that the member has designated to act on its behalf in the delivery and receipt of securities to and from FICC GSD. 4.3.2.5 Risk Management. FICC GSD establishes requirements for participants' financial resources and creditworthiness. FICC GSD maintains membership standards, including minimum financial requirements. Financial requirements are generally based upon entity type, types of services that the participant will use, and whether the participant intends to clear transactions for others. In addition, FICC maintains financial resources, primarily member clearing fund. 26 dealers that are not FICC members or that do not use an interdealer broker to submit trades to FICC may settle their trades on a gross basis either on the books of a depository institution or through the Fedwire Securities Service, described in Section 4.4.1 below, via a depository institution. Non-member dealers may also submit trades to FICC through a dealer member with which they have a correspondent relationship. CPSS, Red Book 2012-497. Deposits, sufficient to cover the failure of its largest member, including the member's affiliated family. The clearing fund consists of deposits posted by members in the form of cash and eligible securities, U.S. Treasury securities, agency securities guaranteed by the U.S. government, and pass-through mortgage-backed securities by Ginnie Mae, Fannie Mae, and Freddie Mac. FICC GSD's liquid resources include cash contributions to FICC GSD's clearing fund. FICC GSD marks all open positions, including forward settling and delivery fails, to market twice daily as part of its funds-only settlement process. Among other payments included in FICC GSD's funds-only settlement are repo interest rate marks, delivery differential payments, and coupon payments. FICC GSD's rules include a loss allocation procedure, which would be invoked if a defaulting member's clearing fund deposit was insufficient to cover losses incurred in the liquidation of the member's positions. If a member becomes insolvent, FICC GSD would first use that member's clearing fund to cover the loss incurred on the liquidation of the member's positions, and any funds available from any applicable collateral sharing arrangements with other clearing corporations. If those deposits were insufficient to cover the liquidation of all positions, the remaining loss would be allocated against the retained earnings of FICC attributable to the FICC GSD in the amount of up to 25% of the retained earnings or such higher amount as may be approved by the Board of Directors of FICC. If a further loss remained, FICC GSD would apply the loss to the clearing fund deposits of its non-defaulting members in accordance with its rules. 4.3.2.6 Links to other systems. FICC GSD uses its two settlement banks, BNYM and JPMC, for the purposes of settling transactions and custody of collateral posted to FICC GSD's clearing fund. FICC GSD uses DTC, its settlement agent, to execute its funds-only settlement over NSS. FICC has entered into a multilateral netting contract and limited cross-guarantee agreement with DTC, NSCC and OCC, under which these clearing agencies have agreed to make payments to each other for any remaining unsatisfied obligations of a common defaulting participant to the extent that these clearing agencies have excess resources belonging to the defaulting participant. FICC has also entered into a cross-margining agreement with the Chicago Mercantile Exchange Inc., CME, which provides for coordination between the two clearing corporations in the event of a default of a cross-margining participant. In addition, FICC has a single-pot cross-margining agreement with New York Portfolio Clearing, NYPC, .27. 27 On the 1st of March 2011, FICC GSD received SEC approval to enter into a single-pot cross-margining with New York Portfolio Clearing, a joint venture between DTCC and NYSE Euronext. On the 1st of February 2011, NYPC received CFTC approval for registration as a DCO. In March 2011, NYPC went live and currently provides central counterparty clearing and settlement services for various interest rate products, including Treasury and Eurodollar futures. NYPC executes its pass-through payments in conjunction with FICC GSD's NSS pass-through arrangement, netting the obligations of common members. Futures contracts that cash settle upon expiration settle through this same NSS arrangement. Futures contracts that are physically settled, a Treasury security is delivered against payment upon the expiration of the contract, are converted into FICC GSD delivery obligations. 498 CPSS, Red Book 2012. United States, 4.3.3 Fixed Income Clearing Corporation, Mortgage-Backed Securities Division, FICC, MBSD. 4.3.3.1 Institutional Framework. The Mortgage-Backed Securities Division of the Fixed Income Clearing Corporation provides trade guarantee and central counterparty clearing and settlement services for the mortgage-backed securities MBS market. .28. These services are provided to FICC MBSD members that trade in the forward and over-the-counter options markets for MBS issued by Government National Mortgage Association, Ginnie Mae, Federal National Mortgage Association, Fannie Mae, and Federal Home Loan Mortgage Corporation, Freddie Mac. 4.3.3.2 Participation. FICC MBSD rules allow for the following types of netting members: banks, broker-dealers, interdealer brokers, issuers of eligible securities, registered clearing agencies, insurance companies, registered investment companies, and unregistered investment pools. 4.3.3.3 Types of transactions. FICC MBSD provides clearing and settlement services for Ginnie Mae, Fannie Mae, and Freddie Mac pass-through MBS, all of which trade over the counter. In 2010, FICC MBSD processed around 3 million transactions with a total value of approximately 104 trillion United States dollars. 4.3.3.4 Operation of the system. MBS generally trade on a to-be-announced TBA basis, meaning the general terms of the trade are known, but the specific pools of mortgages that the seller will deliver are unknown at the time of trade. FICC MBSD members may submit their trades through interdealer brokers or directly to FICC MBSD.29. FICC MBSD members enter their trade information into FICC MBSD on the trade date. Settlement of associated obligations typically occurs on one of 4 monthly settlement dates established by the Securities Industry and Financial Markets Association. Many MBS settle on the next appropriate settlement date, but often market participants choose to settle in a later month. FICC MBSD nets TBA trades by TBA CUSIP, creating TBA settlement obligations 3 days before settlement date S3. The netting process also assigns settlement counterparties for each position, which may or may not be original trade counterparties. On S2, FICC MBSD members communicate to FICC MBSD and one another the specific mortgage pools they will deliver to meet their TBA settlement obligations. On S1, FICC MBSD nets and novates a subset of the mortgage pools to be delivered based on an optimization algorithm. On settlement date S, members whose delivery obligations FICC MBSD novated settle against FICC MBSD. Otherwise, members settle non-novated obligations bilaterally outside FICC MBSD and provide FICC MBSD notification of settlement. 28 FICC, a wholly owned subsidiary of DTCC, also operates the Government Securities Division FICC GSD. As described in Section 4.3.2, FICC is registered as a clearing agency with the SEC and is subject to SEC regulation and supervision. Also, FICC has been designated as systemically important by the FSOC, and under Title 8 of the DFA the SEC is its supervisory agency. 29 dealers that are not FICC members or that do not use an interdealer broker to submit trades to FICC may settle their trades on a gross basis either on the books of a depository institution or through the Fedwire Securities Service via a depository institution. Non-member dealers may also submit trades to FICC through a dealer member with which they have a correspondent relationship. CPSS, Red Book 2012-499. 4.3.3.5 Risk Management. FICC MBSD provides risk management services to its members to mitigate risks inherent in the settlement process, including the possibility of member default. Among the tools that FICC MBSD employs to manage risk are participation requirements, clearing fund requirements, and daily mark-to-market of open positions. FICC MBSD accepts cash and eligible securities, same as FICC GSD, for deposit in the clearing fund. FICC MBSD's clearing fund is calculated, collected and held separately from that of FICC GSD. In addition, FICC MBSD employs a loss allocation procedure similar to that of FICC GSD, as described in Section 4.3.2.5. 4.3.3.6 Links to other systems. FICC MBSD uses DTC as its settlement agent to execute its funds-only settlement over the National Settlement Service. FICC has entered into a multilateral netting contract and limited cross-guarantee agreement with DTC, NSCC and OCC, under which these clearing agencies have agreed to make payments to each other for any remaining unsatisfied obligations of a common defaulting participant to the extent that these clearing agencies have excess resources belonging to the defaulting participant. 4.3.4 The Options Clearing Corporation, OCC, 4.3.4.1 Institutional Framework. The Options Clearing Corporation is an independent clearing house for exchange-traded equity options and commodity futures. OCC currently provides central counterparty clearing and settlement services to 9 options exchanges and 5 futures markets. 30. OCC is owned in equal shares by 5 of its participant exchanges. 31. OCC is registered as a clearing agency with and is subject to regulation and supervision by the SEC. OCC is also registered as a DCO and regulated by the CFTC. Also, OCC has been designated as systemically important by the FSOC, and under Title 8 of the DFA the SEC is its supervisory agency. 4.3.4.2 Participation. Eligible clearing firms must be broker-dealers registered with the SEC, FCMs registered with the CFTC or non-U.S. securities firms that meet certain financial, operational and regulatory requirements outlined in OCC's rules and bylaws. Non-U.S. securities firms must be incorporated, located and regulated within another country. OCC requires clearing members to maintain minimum net capital levels at all times. OCC has approximately 120 clearing members. 4.3.4.3 Types of transactions. OCC offers clearing and settlement services for transactions in options on several types of underlying assets, including stocks, stock indices, exchange-traded fund ETF, shares and foreign currencies traded on OCC's participant exchanges and markets. OCC also offers clearing and settlement services for transactions in futures and options on several types underlying assets, including commodities, stocks, stock indices, ETF shares, foreign. 30 These exchanges and markets include BATS, Boston Options Exchange, C2 Options Exchange, Inc., Chicago Board Options Exchange, Incorporated, International Securities Exchange, LLC, NASDAQ OMXPHLX, NASDAQ Options Market, NYSE Amex Options, NYSE ACA Options, CBOE Futures Exchange, LLC, ELX Futures, LP, NASDAQ OMX Futures Exchange, NYSE LIF US, and One Chicago Exchange. 31 OCC is owned by the NYSE Amex Options, the Chicago Board Options Exchange, Inc., the International Securities Exchange, LLC, the NASDAQ OMXPHL and NYSE ACA. 500 CPSS, Red Book 2012. United States. Currencies, volatility indices and U.S. Treasury securities. In addition, OCC provides clearing services for securities lending transactions. In 2010, OCC cleared approximately 3.9 billion options contracts and 26.6 million futures contracts. 4.3.4.4 Operation of the system. OCC clears and guarantees options and futures contracts. OCC receives matched trade data for trades executed on one of the 14 exchanges or platforms for which it provides clearing services. When a trade is accepted for clearing, OCC is substituted as the counterparty to every buyer and seller through the process of novation and guarantees performance on the contract. Each morning OCC settles payment obligations incurred on the previous business day. These payments include options premiums passed from buyer to seller and margin deposits. 32. OCC requires that all payments due be received by 10 o'clock Eastern Time and is obligated to make all required payments to clearing participants by 11 o'clock Eastern Time. Settlement occurs through settlement banks designated by OCC. Clearing members must establish a banking relationship with one of the settlement banks designated by OCC, which also has an account at each bank. OCC and its clearing members grant settlement banks the authority to credit or debit their respective accounts based on settlement instructions sent by OCC. 4.3.4.5 Risk Management. OCC bears counterparty credit risk in the event that clearing members fail to meet their obligations. 33. OCC reduces its exposure through a risk management program that includes initial and ongoing membership standards, margin requirements, a clearing fund of highly liquid assets and lines of credit to enable OCC to meet clearing member default or suspension obligations, or to cover certain other losses. All trades guaranteed by OCC are matched, which ensures that it has equal and offsetting claims against clearing members. Margin and clearing fund deposits are required to collateralize clearing members' obligations and thus support OCC's guarantee. OCC sets margin requirements based on a member's overall portfolio risk in options, futures and stock loan borrow positions. OCC requires the posting of initial margin in order to guarantee a contract. Initial margin deposits must be in the form of cash, government securities, government-sponsored debt, letters of credit, money market fund shares or other acceptable margin securities and may be subject to haircuts. In addition, OCC marks all open contracts to market on a daily basis and requires additional cash payments, known as variation margin, to cover changes in contract value. Margin requirements are calculated using the System for Theoretical Analysis and Numerical Simulations, STANS, a proprietary risk management system that uses Monte Carlo-based simulation techniques. 34. OCC also maintains a clearing fund to cover possible losses should a clearing member, bank, or a securities or commodities clearing organization default. The clearing fund is a percentage of the average daily aggregate margin requirement for positions outstanding during the preceding calendar month and mutualizes the risk of default among all clearing. 32. OCC requires both initial margin deposits and variation margin deposits to cover changes in contract value. 33. OCC deals only with its clearing members and holds each clearing member accountable for all positions, regardless of whether the positions are for the member itself or customers of the member. 34. The Monte Carlo method is used to build a portfolio profit and loss distribution by repeatedly simulating price movements and their associated results. CPSS, Red Book 2012-501, Members. 35. The entire clearing fund is available to cover potential losses in the event that the margin deposit and the clearing fund deposit of a defaulting clearing member are inadequate or not immediately available to fulfill that clearing member's outstanding financial obligations. In the event of a default, OCC is generally required to liquidate the defaulting clearing member's open positions. To the extent that such positions remain open, OCC is required to assume the defaulting clearing member's obligations related to the open positions. The clearing fund is available to cover the cost of liquidating a defaulting clearing member's open positions and performing OCC's obligations with respect to positions not yet liquidated. 36. 4.3.4.6 Links to other systems. OCC currently maintains cross-margining arrangements with certain U.S. commodities clearing organizations, including the CME and ICE Clear US, as well as offering an internal cross-margin program for products where OCC clears both securities and futures contracts. In addition, OCC has entered into a multilateral netting contract and limited cross-guarantee agreement with DTC, NSCC and FICC, under which these clearing agencies have agreed to make payments to each other for any remaining unsatisfied obligations of a common defaulting participant to the extent that these clearing agencies have excess resources belonging to the defaulting participant. The OCC also participates in the disbursement program, developed jointly with DTC and NSCC, which facilitates the payment of stock settlement obligations of common OCC clearing members and NSCC participants resulting from exercised and assigned equity options. 4.3.5 CME Clearing. 4.3.5.1 Institutional Framework. CME Clearing is an unincorporated division of the Chicago Mercantile Exchange, Inc., CME, which is a subsidiary of CME Group Inc. and provides central counterparty clearing and settlement services for exchange-traded futures and options contracts traded on CME Group exchanges, as defined in Section 4.3.5.3, and certain OTC derivatives contracts. CME Clearing is a registered DCO regulated by the CFTC. Also, CME has been designated as systemically important by the FSOC, and under Title 8 of the DFA the CFTC is its supervisory agency. 4.3.5.2 Participation. Eligible clearing members are corporations, partnerships or cooperative associations that own shares of CME Group and have sufficient financial capital to support the risks assumed in clearing trades. Clearing members must be registered as Futures Commission merchants with the CFTC in order to clear customer trading activity. CME Clearing has approximately 64 clearing members. 4.3.5.3 Types of transactions. CME Clearing clears exchange-traded futures and options contracts traded on the CME, the Board of Trade of the City of Chicago, Inc., Chicago Board of Trade, or CBOT, the New York. 35. The SEC has approved a proposed change to OCC's method for calculating the size of its clearing fund. OCC will size the clearing fund to cover the larger of the charges that would result from a default by a single clearing member group, or the near simultaneous default of two randomly selected clearing members. 36. Clearing fund deposits must be in the form of cash or government securities, as defined in OCC's bylaws, as the clearing fund is intended to provide OCC with an immediately available pool of liquid assets. 502 CPSS, Red Book 2012. United States Mercantile Exchange, Inc. NYMEX, and the Commodity Exchange, Inc. COMEX, which are collectively referred to as the CME Group exchanges. CME Clearing also clears OTC derivatives contracts submitted for clearing through CME Clearport. CME Group handled around 3.1 billion contracts in 2010. 4.3.5.4 Operation of the system. CME Clearing functions as a CCP for the futures and options contracts it clears. CME Clearing matches trade data submitted for trades executed either through open outcry facilities located in Chicago and New York or the CME Globex electronic trading facility, as well as for privately negotiated OTC derivatives transactions. When a trade clears, CME Clearing is substituted as the counterparty to every buyer and seller and guarantees performance on the contract. CME Clearing marks open contracts to market twice daily and settles payment obligations once in the morning and once in the afternoon of each business day. Morning settlement occurs at 8:30 Eastern Time and includes options premiums passed from buyer to seller and initial and variation margin, also known as initial and maintenance performance bonds, respectively, deposits. CME Clearing sends payment instructions to each settlement bank prior to the 8:30 Eastern Time deadline and requests a confirmation of payment prior to the deadline. Afternoon settlement includes maintenance performance bond deposits, which are due within 1 hour of CME Clearing requesting payment from its clearing members. Settlement occurs through designated settlement banks that act as settlement intermediaries between CME Clearing and its clearing members. Clearing members must establish a banking relationship with one of the settlement banks designated by CME Clearing, which also has an account at each bank. 37. CME Clearing and clearing members grant settlement banks the authority to credit or debit their respective accounts for daily market activity based on clearing instructions sent by CME Clearing. 4.3.5.5 Risk Management. CME Clearing bears counterparty credit risk in the event that future market movements create conditions that could lead to clearing firms failing to meet their obligations to the clearing house. 38. CME Clearing reduces its exposure through a risk management program that includes initial and ongoing financial standards, initial and maintenance performance bond margin requirements, mandatory guarantee funds contributions, and lines of credit. CME Clearing sets minimum performance bond requirements based on the product traded and market volatility. Performance bond requirements are calculated for each instrument separately using the CME's Standard Portfolio Analysis of Risk (SPAN) system for futures and options contracts, a historical value at risk (VAR) model for interest rate swaps, and a multi-factor model for credit default swaps. Performance bond collateral may include cash, gold, U.S. Treasury securities, U.S. government agency securities, foreign sovereign debt, select mortgage-backed securities, specialized collateral programs, letters of credit, and stocks, and may be subject to haircuts. CME Clearing also marks to market all open positions at least twice a day, and more often if market volatility warrants, and requires payments from. 37 Clearing members must establish separate accounts at settlement banks for customer and house, non-customer, and proprietary activity. 38 CME Clearing is also exposed indirectly to the credit risk of customers of its clearing firms, as clearing members are held accountable for all positions, regardless of whether the positions are for the member itself or customers of the member. CPSS, Red Book 2012-503. Clearing firms whose positions have lost value and makes payments to clearing firms whose positions have gained value. CME Clearing has measures in place intended to enable it to cover any single default and maintain liquidity. In the event of a default by a clearing firm, CME Clearing would first apply assets of that clearing firm to cover its obligations to CME Clearing. These assets include guarantee fund contributions, performance bonds, and any other available assets, such as proceeds from the sale of Class A common stock and trading rights, at CME, CBOT, NYMEX and/or COMEX, as applicable, owned by or assigned to the clearing firm. 39. Thereafter, if the default remains unsatisfied, CME Clearing would use its surplus funds, guarantee fund contributions of other clearing firms, and funds collected through an assessment against all other solvent clearing firms to satisfy the deficit. 40. 4.3.5.6 Links to other systems. CME Clearing offers a cross-margining program with OCC and FICC. CME Clearing is also involved in the Mutual Offset System Agreement (MOSA) between CME and the Singapore Exchange Limited (SGX), which enables traders to open a futures position on one exchange and liquidate it on the other. 4.3.6 ICE Clear Credit LLC 4.3.6.1 Institutional Framework ICE Clear Credit LLC, ICE Clear Credit, is a limited liability company and provides central counterparty clearing and settlement services for credit default swaps referencing the CDX North American Investment Grade High Volatility and High Yield Indexes, North American Index Contracts, and a subset of their single name constituents, North American Single Name Contracts. In addition, ICE Clear Credit also provides central counterparty clearing and settlement services for Latin American sovereign credit default swaps. ICE Clear Credit is a subsidiary of Intercontinental Exchange Inc. ICE, a publicly traded company which operates futures exchanges, over-the-counter swaps markets and derivatives clearing houses. ICE Clear Credit was formerly known as ICE Trust US LLC, ICE Trust, and was regulated by the Federal Reserve and the New York State Department of Financial Services. On the 16th of July 2011, ICE Trust converted from a New York State trust company to a Delaware limited liability company and changed its name to ICE Clear Credit LLC. On the same day, pursuant to the DFA, ICE Trust began operating under the name ICE Clear Credit, subject to regulation by the CFTC and SEC as a DCO and clearing agency, respectively. Also, ICE Clear Credit has been designated as systemically important by the FSOC, and under Title 8 of the DFA the CFTC is its supervisory agency. 4.3.6.2 Participation. Participants in ICE Clear Credit include broker-dealers registered with the SEC, futures commissions merchants registered with the CFTC and banks. ICE Clear Credit has approximately 27 clearing participants. 39 In addition, CME Clearing would make a demand for payment pursuant to any applicable guarantee provided to the exchange by the parent of a clearing firm. 40 CME Clearing separately accounts for and segregates clearing members' positions and monies from its own. 504 CPSS, Red Book 2012. United States. 4.3.6.3 Types of transactions. Contracts eligible for clearing include certain North American index contracts and North American single name contracts and Latin American sovereign contracts. Once the contracts are cleared, they are recorded in the Trade Information Warehouse for credit derivatives operated by Warehouse Trust. 4.3.6.4 Operation of the system. ICE Clear Credit manages a weekly and daily workflow to clear contracts, requiring the execution of a number of steps by clearing members in the clearing house. The weekly workflow begins with clearing members designating for clearing eligible bilateral contracts registered in Warehouse Trust. Throughout the week, the list of contracts designated for clearing may be modified. The clearing process results in the novation of the bilateral contracts whereby ICE Clear Credit interposes itself between the counterparties to the original CD's contract. Clearing members are provided with margin requirements on cleared positions. The daily workflow allows clearing members to clear new trades on the same day they are executed. The process begins when two clearing members submit the trade for clearing immediately upon trade execution. Once the trade passes a risk management assessment by the clearing house, the trade is accepted for clearing. The trade is then registered in Warehouse Trust, and clearing members are provided with margin requirements on cleared positions. Finally, ICE Clear Credit has developed a workflow for third parties to indirectly clear North American index contracts with ICE Clear Credit via a client relationship with a clearing member. 4.3.6.5 Risk Management. ICE Clear Credit has a risk management framework to manage the risk associated with clearing CD's contracts. The risk management framework is based on a tiered approach. First, ICE Clear Credit maintains membership criteria, which establish minimum levels of financial resources, operational capabilities and risk management experience for clearing members. Second, ICE Clear Credit requires initial margin on open positions to cover potential clearing member portfolio losses in normal market conditions. Third, ICE Clear Credit requires mark-to-market margin on open positions, reflecting the market loss or gain on each clearing member's portfolio of cleared positions. Fourth, clearing members must contribute additional financial resources to a guarantee fund. The guarantee fund is sized to cover potential portfolio losses in extreme but plausible market conditions. ICE Clear Credit contributes to this fund. Fifth, ICE Clear Credit has the ability to impose a limited one-time assessment on each of its clearing members in the event the guarantee fund is exhausted. 4.3.6.6 Links to other systems. ICE Clear Credit supports the delivery of trades to the clearing house via a number of trade execution and matching systems including ICE Link, MarketWire and TradeWeb. As explained above, ICE Clear Credit has a link with Warehouse Trust to identify trades eligible for clearing. 4.3.7 Other clearing systems. Other domestic and foreign systems also clear transactions in U.S. markets. Domestic clearing systems include MGE Clearing, the Kansas City Board of Trade, ICE Clear US, and New York Portfolio Clearing. Foreign clearing systems for derivatives that do business with U.S. persons or registered as derivatives clearing organizations with the CFTC include LCH, ClearNet Limited, ICE Clear Europe Limited and Eurex Clearing AG CPSS, Red Book 2012-505. 4.4 Securities Settlement Systems. 4.4.1 Fedwire Securities Service. 4.4.1.1 Institutional Framework. The Fedwire Securities Service, Fedwire Securities, owned and operated by the Federal Reserve Banks, is a real-time delivery versus payment (DVP) securities settlement system that allows for the immediate, final and simultaneous transfer of eligible securities against funds in central bank money. Fedwire Securities provides a system for maintaining and transferring book entry securities issued by the U.S. Treasury, government agencies, GSEs and certain international organizations. 41. The transfer of securities and associated payment occurs simultaneously and is final when the respective securities and funds accounts are credited and debited. Under the Federal Reserve Act, the Federal Reserve Board is responsible for general supervision and oversight of the Reserve Bank's provision of the Fedwire Securities Service. 4.4.1.2 Participation. Fedwire Securities participants include depository institutions and certain other institutions, including U.S. branches and agencies of foreign banks. Fedwire Securities currently has approximately 2,500 participants. 4.4.1.3 Types of transactions. Fedwire Securities provides issuance, transfer and settlement services for all marketable treasury securities as well as securities issued by government agencies, GSEs and certain international organizations. The Federal Reserve Banks, in their capacity as fiscal agents for the U.S. Treasury, U.S. federal agencies and GSEs, facilitate the issuance of book entry securities to participants in the Fedwire Securities Service. Participants may maintain multiple securities accounts and can use the Fedwire Securities Service to transfer securities to settle secondary market trades, including open market operations, to move collateral used to secure obligations and to facilitate repurchase agreement repo transactions. Fedwire Securities processed an average of nearly 78,000 securities transfers per day in 2010. The total value of securities transfers originated during 2010 was approximately $320 trillion United States dollars. At the end of 2010, almost 57 trillion United States dollars in Fedwire-eligible securities were held in custody. 4.4.1.4 Operation of the system. The Fedwire Securities Service is a DVP-1 settlement system. 42. Fedwire Securities processes securities transfers on a gross basis in real time. 43. During a typical DVP transaction, the sending participant sender initiates the securities transfer by sending a transfer message to the Fedwire Securities Service requesting a transfer of securities to a receiving participant receiver. Once verified, the securities are automatically withdrawn from the sender's securities account and deposited to the receiver's securities account. Simultaneously, the corresponding funds are withdrawn from the receiver's funds account and deposited to the 41. In their capacity as fiscal agents, the Federal Reserve Banks act as the central securities depository for securities issued through the Fedwire Securities Service by the U.S. Treasury, government agencies, GSEs and certain international organizations. 42. Although most securities transfers are made against a designated payment, securities transfers can be made free of payment. 43. Participants can access the Fedwire Securities Service through computer-to-computer service and browser-based service in the same way that participants can access the Fedwire Fund Service. 506 CPSS, Red Book 2012. United States. Sender's funds account. Once the transfer is complete, the Fedwire Securities Service sends both the sender and the receiver notice acknowledging that the message has been processed. The transfers of securities and any related funds over the Fedwire Securities Service are final and irrevocable when a reserve bank makes the appropriate debit or credit entries to the respective sending and receiving participants' securities accounts and corresponding funds accounts. The Fedwire Securities business day begins at 8:30 and ends at 15:15 Eastern Time, Monday through Friday, excluding designated holidays. During these hours, participants can originate online securities transfers. Online participants can initiate reversal transactions until 15:30 Eastern Time and move reposition their securities among their securities accounts until 16:30 Eastern Time for payment and until 1900 free of payment. Offline participants can initiate securities transfers or other requests from 9 o'clock to 13:30 Eastern Time for same-day processing and until 1600 Eastern Time for future day processing. Under certain circumstances, the Fedwire Securities Service operating hours may be extended by the Federal Reserve Banks. 4.4.1.5 Risk Management. Subject to certain conditions, the Federal Reserve Banks extend intraday credit to Fedwire Securities participants lacking sufficient balances to cover Fedwire Securities purchases. The PSR policy describes tools such as debit caps, monitoring, collateralization, and daylight overdraft pricing that the Federal Reserve banks use to limit credit risk when extending intraday credit to Fedwire securities participants. In 2010, aggregate average daily daylight overdrafts for Fedwire securities was 3.8 billion United States dollars and aggregate daily peak daylight overdrafts was 57.2 billion United States dollars per day. The Federal Reserve banks manage operational risk using the tools discussed in Section 3.2.1.5. 4.4.2 The Depository Trust Company DTC 4.4.2.1 Institutional Framework. The Depository Trust Company is a central securities depository and securities settlement system. DTC is a wholly owned subsidiary of DTCC. DTC is registered as a clearing agency with the SEC and is subject to SEC regulation and supervision. DTC is also chartered as limited purpose trust company under New York State banking law and is a member of the Federal Reserve System and is thus supervised by the New York State Department of Financial Services and the Federal Reserve. Also, DTC has been designated as systemically important by the FSOC, and under Title 8 of the DFA the SEC is its supervisory agency. 4.4.2.2 Participation. DTC's participants include brokers, dealers, banks, investment companies, and similar entities. A number of DTC's participants are also participants in NSCC given DTC's provision of settlement services to securities transactions cleared and risk managed through NSCC. 4.4.2.3 Types of transactions. DTC provides clearing, settlement, and central securities depository services for trades in eligible securities including equities, corporate bonds, municipal bonds, and money market instruments (MMI), such as commercial paper. The total value of securities on deposit at DTC amounted to approximately 36.5 trillion United States dollars in 2010. 4.4.2.4 Operation of the system. DTC operates a DVP2 settlement system. Securities settle on a gross basis at DTC intraday and associated funds settle on a net basis through NSS at the end of the day, approximately 16:30 Eastern Time. To facilitate the settlement of securities transactions intraday, DTC allows receiving participants to incur a net money debit during the day up to a net debit cap. CPSS, Red Book 2012-507, established by DTC. In addition to its net debit caps, which DTC applies to individual participants and to affiliated families of participants, all net debits are fully collateralized, with haircuts, and DTC's risk management builds in an added layer of protection against an MMI issuer failure on the same day as a participant default. 4.4.2.5 Risk Management. Risk management controls play a major role in the design of DTC's settlement system. DTC's risk management controls are based on guidelines established by the Federal Reserve for book entry securities systems that settle over Fedwire funds. DTC currently employs three primary risk management controls for securities processing: I. Collateralization, E. Net debit caps, and E. Largest provisional net credit (LPNC) control exclusive for MMIs. Collateralization is meant to ensure that a participant that fails to pay for its settlement obligation will have collateral in its account sufficient to cover that obligation and available to be liquidated in the event it were insolvent. DTC's collateralization monitoring procedures prevent the completion of transactions that would cause a participant's net debit to exceed the total available collateral in its account. Similarly, the application of net debit cap controls helps assure that DTC has sufficient liquidity to cover the failure of any single participant or of a financial family of affiliated DTC participants. DTC's system prevents the completion of transactions that would cause a participant's net debit to rise above a specific amount, its net debit cap. Participants' net debit caps are limited by DTC's established maximum net debit cap, the value of which is always set lower than DTC's total available liquidity. 0.44. In addition to collateralization and participation requirements, DTC maintains a participants' fund. In addition to being a liquidity resource, the participants' fund is available to satisfy any uninsured loss incurred by DTC, including a loss resulting from a participant's failure to settle. In the event of such loss, DTC would first charge the loss to that participant's deposit to the participant's fund, including its voluntary deposit, if any. If the loss exceeds the failing participant's deposit, DTC can charge the excess to its retained earnings or pro rata to the required participants' fund deposits of all other participants. Should DTC make a charge against a participant's required deposit to the participant's fund, pro rata or otherwise, the participant must make an additional deposit to the participant's fund in an amount equal to the charge. 4.4.2.6 Links to other systems. DTC provides book entry securities settlement services to NSCC's continuous net settlement. DTC also acts as settlement agent to FICC GSD and FICC MBSD to make certain funds only pass through payments on behalf of NYPC. DTC has entered into a multilateral netting contract and limited cross-guarantee agreement with FICC, NSCC and OCC, under which these clearing agencies have agreed to make payments to each other for any remaining unsatisfied obligations of a common defaulting participant to the extent that these clearing agencies have excess resources belonging to the defaulting participant. 44. In addition to requiring participants to have sufficient collateral to support their net debits and ensuring that their net debits do not exceed their net debit caps, an additional procedure, LPNC, has been established to ensure that the occurrence of a combined MMI issuer's default and a participant's failure to settle does not expose DTC to loss and liquidity risks. 508 CPSS, Red Book 2012.